All right, let's turn back to the market and get more now from Mike Schumacher, Global Head of Macro Strategy at Wells Fargo Security. Welcome, Mike. Good to have you with us.
Thank you, Taylor.
What do you think as we look ahead to the Fed tomorrow? Any blazing insights there, or you expect it to be a skip meeting?
Fed's not going to move tomorrow, but it's challenging for Powell in particular. He's got the press conference, so he wants people to think the door is still open. Hey, maybe we'll hike, maybe in November, maybe December. You've got this government shutdown, which is kind of a complication. He wants to make people think that's still in play, but not actually hike tomorrow. It's really a pretty tough line to walk.
He's got inflation moving in the right direction for the most part over the last year. But what if it doesn't get to that target that they have been so articulate about? 2%, 2%, 2%, but it stays somewhere above that, 3%, 3.2, 2.8, something like that. Is that their sort of worst case scenario?
That's a really bad scenario for the Fed and for other central banks as well. Tim mentioned Canada this morning, bad inflation data there. It's a tough look for the Fed, ECB, whomever. So the question then becomes, what does the Fed do? Let's say not tomorrow, maybe in a quarter or two, if inflation has come down a little bit more, but it is sticking at 2.7, 2.8. Does it renew hiking? Does it try to jawbone it down? It's a really tough problem. So I'd say that's the nightmare scenario.
Are you in the higher for longer category or not?
At this point, I think it's less about when the Fed actually delivers a rate cut and more about when it signals that we're done hiking. And there are different things for the markets. So we're very much in the camp the Fed is about done hiking, whether it already happened back in July or perhaps it's next month or November, rather, who can say exactly, but somewhere in there. It's not so much about the first rate cut.
Mike, I saw in your notes, you think money markets and what investors are earning at the short end of the curve is a really attractive place to be in terms of allocation, and it's not necessarily fleeting. Some of the arguments you hear from folks is lock in some of that yield because there's reinvestment risk as the Fed quickly falls out of bed. What are your thoughts there?
Still true, Tim, but it's interesting. Last time I was on the show about a month and a half ago, I said buy short-term, but also buy longer-term bonds. We're sticking with that call.
Yep.
So 10-year Treasury gets down to 350 plus or minus at the end of the year. It's looking like a braver and braver position, but we'll stay there. And the reason, again, is that once the Fed really intimates it's about done, yields typically move down very, very quickly, 50, 60 basis points over the span of a few months. We think that's still likely to happen.
All right, so 3.5%, I hear. So what does 4.36 in 10-year yields tell you today? What is the market looking at?
Tells me the market's not looking at my notes. Got to read up a little more carefully next time around. But I do think the supply issue's been a bit of a concern for people. And really, it's this notion that it's not just the Fed, but so many central banks are looking to move policy at about the same time. People out in the investing world, and also on the issuing side, too, we've talked to a lot of corporate clients recently, they need to see something a little more tangible from the central banks. Hey, we're just about done. The ECB delivered something like that last week. If the Fed were to do something like that, not tomorrow, but fairly soon, I think that would make people a lot more comfortable.
Karen?
So the supply thing, though, I do think is relevant further out the curve, obviously. But if you look at some of the factors, like we just talked about oil, since July, oil is up a lot. I mean, how can they? I think our next inflation print is actually going to go the wrong way, which I think don't you think that would put more pressure on the Fed to not be at the end?
Yeah, that's tough, Karen. It's a good point. When you think about things like oil rocketing up, most important price in the world, you can't ignore it. You can't say, well, it's not part of core inflation. That's not what we focus on. That's a little too simple. And your average American says, hey, I eat and I drive my car. Those are the things I care about. If I pay $7 a gallon for gasoline, as you did, that's a bad scenario. So the Fed can't dismiss it. So it's a pretty bad look. But at the same time, the Fed can say, hey, look, labor conditions have softened a little bit. The market's not as tight as it was. That's probably a good thing. I'm not saying more people need to lose jobs, but still need to have hiring become a little bit easier. And that's probably a more long-term fundamental factor. So, again, the Fed is really trying to thread the needle here. But if oil does keep going up, it's going to make it much tougher.
Where do you think the 10-year yield is 6 months from now? March, springtime.
Yeah, so, again, we're calling 350 at the end of the year. It's probably a little optimistic. I'd say mid-threes, perhaps not very different than our year-end call. But again, it really hinges on the Fed signaling not so much that first rate cut is imminent, because it probably isn't, but hey, we're done with hiking. But that nightmare scenario we talked about a second ago, Tyler, inflation gets stuck, then the Fed doesn't really have a lot of room, and 10s are probably a lot higher in yield.
And there are a lot of other central banks that have decisions coming up right this week.
This week?
Yes.
It's a big week.
Yeah, big week.
Yeah.
So you're going to have a lot to process, a lot to digest.
That's right. Ton of news, really, over the next 2 days. You've got the Fed, Bank of Japan, Bank of England, various others, Norges Bank. So it's a huge amount of news for the markets. That's right. And if a couple of those things go the wrong way, it probably does put upward pressure on bonds.